Good morning, everyone, and welcome to a very special event for Seven Investing this morning. I'm joined today by Paul Gu. Paul is the CEO of Upstart Holdings. This is a company that's taking an innovative and disruptive approach to the consumer lending market. Paul, before we get started, we are big fans of your company here at Seven Investing. You're a multi-recommendation in our scorecard. I've personally been an investor in Upstart since 2021. I know that I speak on behalf of everyone who's watching this show when I say thank you for the time this morning and welcome to the program.
Thanks. Yeah, excited to be here and grateful for your guys' support.
Fantastic, Paul. So I wanted this to be, as I was preparing for this conversation with you, not just another conversation with the media. I wanted to distill this down and really just focus on two important questions that were ones that I don't believe I've heard anyone else asking. And chatting with your IR team too. These are things that aren't coming up necessarily on those quarterly conference calls, but I think they're still important to the long-term strategy you're building with Upstart. Before I jump into those, a little bit of background for anyone who might be less familiar with your company. You guys have taken what I consider a disruptive approach to the lending market, right? Where there was a certain group of people who wanted to borrow money that maybe didn't fit into the traditional boxes or didn't have the right FICO credit score to get approved for the loans, at least from those traditional institutions. I know that you guys have been working more than a decade in kind of building out the models that would identify the credit worthiness of a lot of those borrowers and then also making credit available for them. This is awesome. It's fantastic to see what you're doing. I'm very excited about Upstart's future. But I think that kind of serves as the basis for the first of my questions, which is that a lot of the initial work that you've done with Upstart has been serving these unsecured loans. These are for products that are maybe a little bit higher APR, a little bit riskier. These are personal loans that people are taking out, and perhaps that was the pool that a lot of the more traditional lenders weren't fishing in. You've done fantastically well. You're still growing the top line incredibly well. You're very profitable in doing this. But my first question is, I've seen that you guys in recent quarters have kind of been expanding into more secured product lines. HELOCs, home equity lines of credit, auto loans, things that have got collateral that might be a little bit less risky than the first ponds that you went fishing in. Do you think that the models that you built, these proprietary AI models have got more than 1,000 inputs that you've done so well in building, do you think the advantages that you had in those initial unsecured loans and in identifying creditworthiness, does that translate into these new secured products where maybe there's a little bit more competition with competitors who are more comfortable with these types of borrowers?
Yeah, no, it is a great question, and I think it's exactly the sort of long-term minded question that isn't discussed a lot when people think about the company. Probably, maybe just to take a step back, I'd say, you said in your remarks, we've been working at this unsecured personal loan business a long time. That's absolutely right. We started the company back in 2012. We did start with this focus on people who were really kind of obviously underserved in credit markets. We thought initially that was just people that were maybe newer to credit, younger. But over the years, we kind of discovered it's not just people that are maybe in their 20s, haven't built up a credit history yet, though, of course, it is those people. We discovered that there are actually people across all walks of life that are falling through the cracks of the credit system, even people that kind of think that they're served okay, people who maybe have okay to sort of mid-range credit scores, have a bunch of different credit products, cards, autos, maybe a mortgage. We've sort of discovered that there are people really in every segment that are either being forced to get the types of credit that are not right for them, pay too much for their credit, or go through too difficult of a process to get that credit. And that's true in personal loans, and actually is the story of how we've been able to continue growing that business despite being over 10 years into doing that business. We're still growing it at a fantastic rate, and we expect that to continue for a long time to come. Now, as you've said, in transitioning to the question you want to discuss about new products, I think something that almost nobody is essentially valuing in the company today or knows how to value today is, what will the future of all of our non-personal loan businesses look like? I think today we're mostly valued as a personal loan business. Most of the questions we get asked are ultimately in some shape or form about the margins or the growth rate or the take rates of the personal loan business, because that reflects most of the financial numbers of the business today. And there's, I think, a lot of questions about what to do if you're building a model of the company. What do I do with auto and HELOC and all this sort of stuff that we're going to work on next? Um, and the nice thing about all of these additional products is that in a very fundamental sense, we're going into the ones that have the same core problem that personal loans does. We're going into these markets for the same reason that we went into personal loans originally, which is when you look at these markets, it's really very clear that there are a bunch of underserved people, systematically underserved people who, again, are either not getting approved, paying too much, or going through too difficult of a process. And it breaks down a little bit between home and auto, but really like the same core problems are there. And I think even though you might say there are more players there, I think in some ways, yes, there are more players maybe in auto, but the market is also just sort of a lot more sort of used to a particular way of underwriting those loans via a sort of common system in dealerships. And we've come and built something completely different. HELOC, similarly, yes, there are a lot of banks and credit unions that do HELOCs, but the traditional process for doing a HELOC is almost unimaginably slow compared to anything you would experience in personal loans land. So yes, more competition, but in some ways, many more problems to be solved. And so that's the opportunity space. It's very, very large. The next thing I think that's important to know is that these markets are sometimes 10 or more times larger than the personal loans market. So these markets, even if they're more competitive, they're so much larger that it's almost in our view, almost guaranteed that if we're successful in these markets, that they're going to create growth runway for many, many years to come on top of what we're already doing in personal loans. So essentially the 1-2 punch, I think, of the business strategy is like run a really, really good, really profitable business in our core personal loans business, and then expand the sort of horizon of growth so that we can continue compounding at the same rate for a really long time. And we do that second piece by adding additional markets, which today for us are principally around auto purchase, auto secured personal loan, HELOC, and our next one after that is cash line. And now if we talk about like, okay, well, what will it take for Upstart to actually be good in these products? How good can our technology edge be there? Because that's really what drives the differentiation for the company, allows us to have the superior economics that we have in personal loans. Then actually, I think the thing that maybe is a little underappreciated about the business is people always think of like a model as like a static thing. It's just like people will ask a question like, oh, is your model good in auto? And it's like, well, yes, our model is good in auto. But it's not as good as our model is in personal loans today. But actually, that is sort of the wrong question to ask. Actually, the question that's interesting is about velocity and the sort of rate of progress of the models, how much better the models can get, what kind of system we've built for kind of structurally improving both the algorithms and the data, which are the inputs that feed a good model. How much can those things just continue to compound over time? That's what's going to drive the sort of long-term value of the company, as opposed to just like, if you take a static snapshot of the model today, is it just as good in HELOC and auto as it is in personal loans? Of course not. But does it have the potential to be just as good? Does it have the potential to sort of continue to compound in its sort of accuracy and its level of automation, just like we do in personal loans? I think the answer to that is clearly yes. And in that, on that dimension, it has some pretty large advantages compared to our history of doing personal loans. In personal loans, we really didn't have anything to build off of. We were starting from scratch on everything, all the pieces of sort of the puzzle of how you stand up one of these businesses. There was no credibility, no investor recognition that these models can even work. And of course, you lacked this basic building block of an understanding of the borrower risk, which is what the personal loans model gives us, which is a relevant foundation for everything, right? Whether you're giving someone an auto loan or home loan or personal loan, you're underwriting the person. Now, in an auto loan, you have to also underwrite the car. In a home loan, you have to also underwrite the home. Those pieces are new to us. The models are still getting better at those pieces of the puzzle, and they will get a lot better. But we have a really great foundation, which is the starting point of knowing better than anybody what the risk of that underlying person is.
Yeah. So Paul, if I can package a lot of that together there, knowing that the models are dynamic and they're always improving, you've now at least validated them in personal consumer loans. You're now going to translate a lot of those learnings to auto and to home. Different markets perhaps, but still kind of a similar strategy of finding where the underserved groups of these new markets are, serving those use the same strategies before you think that the strategy will continue to work in these secured products too. Is that right? Is that a fair assessment?
Yeah, exactly. I mean, it's sort of a boring answer, but it's like, we think that the thing we've done in personal loans is a really, really good strategy. It's created a really fantastic business. It's powered by an incredible amount of tech differentiation. And we think essentially the same problem exists in these much larger credit markets. And we're just going to take the same strategy and apply them over there. And we think we can chase a much bigger prize.
Sounds disruptive. I love it, Paul. Congratulations. For anyone listening, by the way, 77% of Upstart's applications they're getting in their core markets right now are actually automatically approved. They built a better mousetrap that's much more efficient out there. They grew their auto loans 4x year over year to 20,000 in the second quarter, and their home loans doubled to nearly 3,000 in the second quarter. So some really good growth in those new product lines. My second question, Paul, is I'm going to transition. I'm going to segue a little bit to something else here. Was something else that you guys did that was a big strategic move here recently? You applied for a national banking charter. It's conditionally approved, I believe, right now for Upstart Bank,
Right.
which is across the entire nation, right? Not just a state by state thing. But this is, of course, if you got your own banking charter, you can get cheaper deposits. You can offer perhaps lower interest rates. There's a lot of advantages with this. One thing that I wanted to bring up, though, is that a lot of your customers are regional lenders. These are regional banks that maybe are working with Upstart to go out and find originations for loans. You package them, you find the people, and then they take care of those loans over time. I wanted to ask, now that you guys have a banking charter and you have the ability to raise deposits, make any kind of loans that you would like to out there, how will this influence your relationship with regional banks? Is there any kind of conflict, do you think, with what Upstart is doing, with what your customers are wanting you to do? Or how are you going to manage those relationships going forward, if differently in any way from how you're doing today?
Yeah, we had really great conversation with our partners on this, and the vast majority of our partners, I think for them, almost nothing economically meaningful is going to change as a result of what we're doing here. And if anything, it's going to be a really nice operational simplification. And the reason is that we have a slightly different reason and motivation for doing the bank charter than I think many other companies that go down bank path by one means or another. They're doing it because fundamentally they are sort of a balance sheet driven business, and that's how the primary strategy for funding loans. And that basically means that collecting deposits becomes very central to what they're doing. And once collecting deposits at the lowest possible cost becomes very important, then they are directly in the business of competing with other banks for that depository relationship, which is sort of the most important thing for a lot of these banks. In our case, the motivation is very different. For us, actually, we just want the sort of maximum amount of operational simplification that we can achieve. We want the least complexity in the system. We want the least kind of economic friction, economic cost in the system. And today we operate in a system where we originate loans via this large network of different originating partners. Those partners are themselves banks that are chartered under different sort of licensing regimes, different states. And many of those are sort of state chartered banks. And as a result of that, there is this kind of patchwork of different laws that apply in different situations. We aren't able to offer all of our products up to the sort of maximum sort of 36% rate cap in all states. And then we have sort of economic friction in the form of certain of these origination arrangements involve costs that ultimately then get passed on to borrowers in the form of higher APRs. And so we looked at the bank charter opportunity as one where we said, hey, we can dramatically simplify the process for originating a loan that will reduce the amount of regulatory complexity, the amount of economic costs that's getting passed on to borrowers, the amount of kind of complexity in where we can originate, who we can serve, and ultimately we can serve much more efficiently many more people. And that's going to be a good thing for us, and it's going to be a good thing for our partners who want to be able to serve those borrowers and still ultimately have really good assets with really good risk returns on their balance sheets.
Yeah, fantastic. Win-win for both parties, right? You guys have operational simplification. It results in better rates for their customers ultimately. It's not a conflict of interest, not competition. It's just making the system more efficient.
Exactly.
Yeah, great. Well, Paul, those are the two that I had. While I do have you here and you're chatting with individual investors who might be interested in Upstart, is there anything else that we missed that, you think investors should know about Upstart right now, or perhaps even a question or a topic that you're not getting asked enough, but you want to be asked about more often that we should be paying more attention to?
I think there's, as I kind of said on the last earnings call, I think there's so many things that are misunderstood or kind of underappreciated about the company and the trajectory that it's on today, that I think you could almost take any topic and say, man, I feel like there's so much more that I wish investors knew. I think you can tell a story about this company that's like almost like a value stock story, where it's just like you don't even have to believe any of the sort of interesting tech stuff or the sort of multi-year product vision stuff. You just kind of look at this as like a basic almost value pitch, and it could kind of make sense, which I think is almost like unimaginable for like a company that's growing at the rate that we're growing. I mean, you almost never see those two things happen at once. And I think that's kind of one of the really cool things, I think, for anyone looking at the companies, is there's so many different angles you can take on it. And so I kind of don't think that, you have to focus only on one set of questions. I think you could take it in any direction, because there's sort of a lot of different interesting angles on what's happening here.
Yeah, fantastic. Well, Paul, you're doing a fantastic job. You know, new to the CEO helm role, but if anyone wants to learn more about Upstart, ir.upstart.com or at PaulXGoo. You've done a really good job of simplifying the complexity in a way that investors can really understand what's going on out there. Really appreciate your time here this morning with 7 Investing.
Okay, thanks, Simon. Good to be here.